Welcome back to another episode of the Gold Standard Retirement Plan with Kevin Dauphinee. I'm James Anderson, and here, obviously, with Kevin Dauphinee. Kevin, it's great to have you back in studio.
Good to see you again, James. It's wonderful to be here.
Now, you recently had a trip where you went and visited your family. How'd that go?
Well, yeah, I was up in Bend, Oregon, visiting with my son and granddaughter, and we had a little bit of outdoor stuff and did some Mount Bachelor things. Went up to a lake with my little 3-year-old granddaughter.
Oh, man.
Splashing around and shoveling sand with her pail. It was wonderful.
What a great time. It's awesome. I mean, I don't have any grandkids, obviously, but being able to spend with my kids time with their grandparents, it's so important, especially these days, to have that family time together.
It was great. It was just wonderful.
Now, I was reading an article the other day, and it was an article that was just talking about some of the regulations that the IRS has finalized, or I should say formalized, regarding RMDs. It was some things that were proposed back when the Secure Act was coming into play.
Yes.
And it seems like any more these days, RMDs are becoming a really big topic. A lot of questions that people have about RMDs. So today, that's what we're going to talk about, is RMDs and how to manage them, how to structure them, and how to go about it to optimize.
Yes.
So on that note, give us a quick background or just a summary of what RMDs are. Educate our listeners really quick on RMDs.
Sure. Well, RMDs are required minimum distributions, which the IRS mandates distribution from tax-deferred accounts such as 401k, IRA, 403b, 457s, some defined benefit plans, lots of different categories that an advisor will provide guidance for the client on how to go about that. And it starts today at age 73. It's kind of complicated, but if you're 73 today in August 2024, you're going to have to take out about 4%. That's the number, right around 4%. Now, that's ordinary income. It's not taxed or anything like that. It's ordinary income that's added to your Social Security and any other income sources. So it can bump you into the next tax bracket, and that's why we advocate Roth conversion as much as possible and some other techniques that are available to investors to minimize the impact of RMDs.
Okay, so around that note, you get to the age of 73, it's time to start taking RMDs. Once somebody knows that they need to take an RMD, how do they figure out how much they need to withdraw and can they delay it? Sometimes people are like, I don't want to take it out yet. Can they delay taking RMDs?
You can certainly delay it if you're still working. That's the only way you can delay it. So the first year that you take RMDs, the distribution must occur prior to April 1st of the year after turning 73.
Oh, gotcha.
But every year thereafter, it must be distributed prior to December 30th. The 31st. December 31st is the deadline. So what we do with our clients is we start making sure around December 1st, that's where we do the calculations well in advance so they know what the impact is going to be, but we don't pull the trigger because we don't want to lose those gains that are in the account over that period of time. But we don't want to wait until after December 15th. That's where it starts to get a bit dodgy in terms of money movement because everybody in the country that's of that age is taking money from there. So Schwab is really put to the test to meet these deadlines. We like to do it a little bit in advance.
Yeah. When going into plan, do you guys have an example of a case scenario? I mean, people have money in their 401ks, their IRAs, their Roths, their 403bs. Maybe they have pension, they have Social Security.
Sure.
So how do you guys help your clients plan around that?
Interesting example that I can cite. A client that I've been working with over the past couple of years just retired on 1st of April. Oh. And at the time, he had not only a pension, a lump sum that he could move into another investment, but also a 401k. So we made a wholesale change, basically moved all of those funds into his investment account, into an IRA, and that was the beginning. Now, the previous custodian of the 401k, they took his RMDs out already. And then he made arrangements to withhold federal and state tax. He's in a state that has state tax. So that was all looked after. So as we move through time this year, we'll be calculating very precisely what his obligation is and making sure that withholding is consistent with his wishes.
Gotcha. When it seems like anymore these days, anytime you talk about any topic in retirement, taxes seem to surface. I mean, with all the people that you've talked to, all the people I've talked to, it seems like taxes permeates itself into every aspect of your retirement plan. And RMDs is no different. Obviously, it creates a taxable situation because it's coming from a tax-deferred account. So with that concern of taxes, what strategies can someone utilize to minimize their taxes?
Well, the most significant opportunity to reduce taxes is the Roth conversion. And the way that we provide guidance to our clients is a piecemeal approach. We do it over a period of time so the tax burden isn't too much. Now, we'll dial that up or down. I've talked to folks that are one of my prospects right now is 59 and a half. He's approaching 60 pretty soon. So the amount that he can afford to take out, because it's better. Let's say that there's $100,000 that's at stake, and the average and the effective tax rate is 15%. So what we want to make sure is that $100,000 goes into the Roth, and that there's $15,000 available somewhere in cash or some other source, the taxable kind of account that will be able to pay the tax come April 15th. So that's the number one. Another one that people aren't so much aware of is qualified charitable distributions. So let's say you wanted to make a $20,000 donation to somebody. You could take that $20,000 out of your IRA or 401k, or any tax-deferred account. That would count as an RMD, but it's not income that shows up on your tax return. So that $20K goes to the charity. It counts as an RMD, but it's not counted as income.
Regarding penalties, because it seems like that's another question is,
Sure.
Well, if I don't take it out, am I penalized? Obviously, there's taxes and whatnot, but what kinds of penalties will people face if they don't take out their RMDs?
Excise tax. The old rule is if you are short on your RMD, that short amount will be taxed at 50%. So that's why advisors until Secure Act 2.0 have been adamant about make sure you take that money out, because you don't want to pay another 50% just for the privilege of not doing what you're supposed to do. So Secure 2.0 has provided a little bit of leeway that over the 2-year period from the offense of not taking out sufficient distribution, that penalty could be somewhere between 25%, 10%, or even zero if it's all looked after within a 2-year period. So, as an advisor, I'm going to say, talk to an advisor. Make sure you speak to somebody that has knowledge about this, because the penalties are onerous and you want to avoid those unnecessary costs.
Yeah. I mean, you've seen a lot of these cases. From your perspective, what are some of the biggest pitfalls that retirees make regarding RMDs specifically?
Well, understanding how it impacts the tax return. And an RMD can bump you up into the next tax bracket, which is unpleasant. Of course, it's bracketed, and you end up with from the 10 to the 12 to the 22 to the 24% tax brackets up to about $340,000. So it's a very simple calculation how you come up with the tax number and how you calculate the effective tax rate, which is the adjusted gross income divided into the tax amount, the tax that's due, and that's the effective tax rate. And I've seen folks with $150,000 worth of RMDs to have an effective tax rate somewhere in the ballpark of about 15%. But we'd like to get that a little bit lower, and we can do that incrementally. And that's the key, is to do it over time. We have 2 years from August of 2024 to get those converted, those qualified accounts converted into Roth. We don't have to do it all in 2 years. We'll let it progress out over a period of time, and we have the ability to calculate what those tax burdens are. And it's rather straightforward for us to do. And I've been doing it for quite a while now. That we're very confident that the work that we do in that area is precisely accurate.
Yeah, and I guess what people also don't realize, and you kind of alluded to this earlier, but RMDs may start at X amount when you first start taking out, but over time, the amount that you have to take out increases in terms of the percentage of the amount that you have to take out, which, if you're not careful, can bump you up into higher tax brackets and different things to where your tax liabilities now go up as well, thus making the argument for Roth conversions today even that much more important.
Right. Well, the actuarial table on the IRS site is basically your longevity from a period of whatever the year is. So let's say that you're 73 years old. I think the longevity is in the ballpark about 25. So you take that 25 and divide that into the amount that is in the total qualified account. So you could have 6 or 7 qualified accounts, total them all up together, and then divide that number, that longevity number, into that total amount, and that's what the required distribution is. Kind of a handy way of doing that rather than, it's easy to multiply by a fraction. So what we do is take the reciprocal of that longevity number, and that gives us a fraction. And that's how I referred to that roughly 4%. It's about 3.9 plus for a 73-year-old today.
Now, for those that want to go maybe a step further in this, I mean, we've talked about some of the, in 15 minutes or so, there's only so much you can dive into. But for those that really are interested in figuring out how to minimize the tax impacts or different things that impact your RMDs and the amount of money you have to take out of it, what are some of the strategies that you guys help implement with your clients?
If you have taxable accounts that are of some significance, one very interesting way, depending on your age and your health and so forth, is placing that money into a cash value life insurance policy, because that cash value policy will increase over time, and that money is always free, tax-free, back to the insured, and of course, in the case of a death benefit, that goes tax-free to the beneficiary. But this is a concept of being able to have this growing asset. It's a diversified asset, if you will. And in the event of some emergency, for instance, long-term care, if there was, let's say, a new roof is necessary on a home, something like that, tap into that life insurance policy. There's no tax at all on the withdrawal. Now, there could be some exposure to interest to pay back that loan, because it is a loan. It acts as a loan to stay within the guidelines of the IRS. But the dividends that are being paid to that contract, it's possible that the dividends could pay that interest in the account. You basically not lose anything in terms of cost.
It's fascinating stuff. I think that RMDs are a really interesting facet of retirement planning that we're all, if we have those accounts, we're all going to have to figure out, and if we manage it appropriately, it'll be great. And if we don't, it could create some real problems for the amount of money that we have, the income that we have in retirement. So now that we've talked about all this, I'm kind of wrapping up. What are some of the biggest takeaways that you want our listeners to know regarding RMDs?
One of the most important aspects of retirement planning is what our future taxes are going to look like. So if you're exposed to RMDs, which you, of course, are if you have qualified accounts, tax-deferred accounts, that's going to have a significant impact on the actual net amount of money that you'll be able to spend for your lifestyle. So the idea of a Roth conversion permits you to avoid those taxes altogether. So we anticipate that taxes are going to increase significantly. So if you have a 20% effective tax rate today, 2030, which is only 5+ years away, that tax rate could be as high, effective tax rate could be as high as 30%. So that'd be a big hit to retirees, a huge hit. So that's why we're very confident that we can help those clients avoid that increased taxation. Now, U.S. debt just surpassed $35 trillion, and the amount of interest that's paid out of the national budget is significant. So that has to be addressed, and we just can't continue on this open-ended approach. If we don't, it leads to runaway inflation. So a lot of people still grousing about 2022 with 9%. I was in the grocery store, and it wasn't Whole Foods. It was in a regular garden variety grocery store, and I bought an onion and a tomato, and they're both $1 each. Oh my gosh. Really. So, of course there's inflation. It's mitigated somewhat, but we also have to take into account that business owners, the large corporations, are going to take advantage of this if they can. Nobody's going to stop eating, but I see it used to be an onion would cost 25 cents or something like that. Who knows? Anyway, that's a little bit of a digression.
Well, it's certainly an important thing. I mean, I have 6 kids at home, and the cost of groceries has doubled, it feels like. I mean, granted, I have a teenage son, and he eats a whole lot more than he used to as well, so I'm sure that has something to do with it. But, well, this has been a great conversation, Kevin. Thank you for taking the time to talk about RMDs. I know it's a topic that a lot of people have questions about, and frankly, I don't think that they always know exactly how to manage it. And so at the end of the day, we just invite our listeners that if they have those questions, to schedule a time and meet with you in your office and your team, and you guys can help them put together a plan that will help mitigate the tax liabilities that they might face within the RMDs, as well as just managing them. So if you like this episode, we invite you to subscribe to our channel, like it, and we'll see you on the next one.
Thanks very much, James. Good to be with you again.